Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. It should come as no surprise that the grain and oilseed markets are a bit under pressure, especially with Brazil and South America having record forecasts for their harvests. Right now, we're looking at May corn, and currently the market has been remaining inside of a trading tunnel that has kept the market in check for quite some time. Most recently, the market came through, and we are once again testing outside of the channel with a nice little break today. On Thursday, we're going to have the supply and demand report for March, and that report historically does move the market significantly, so we would not be surprised to see a bit of volatility and a bit of movement in these markets as that report comes to fruition. We're currently trading at about 372, and we have the point of control sitting at 366. So come Thursday, we're looking for the market to potentially continue downward and look to find some support near that 365 to 366 area, which would coincide with previous lows. Below that level, the market could potentially push a little bit lower, but we do think about 366 to 365 may in fact hold for this contract. Nearby levels of significance for this contract sit at 383.5 overhead. A near price right now at 373 and 3/4, and then down below at 364. And so that 364 coincides with the levels we just discussed not too long ago. We have our key support and resistance levels that are commensurate to where the price action is right now. The point of control for the July corn contract rests at 372, and so it would be somewhere in the neighborhood of 375 to 372 where we would anticipate good support for this contract on the way down, potentially to the point of control. But keep in mind, this 360-degree 375 mark should also prove to be fairly formidable, depending on the information that we find from the supply and demand report due on Thursday. A quick look at the December contract shows that one standard deviation below the point of control sits at 387 and a quarter. This is where we'd be looking for potential support on the way down should the market collapse. Just above right now, we have our 135-degree mark with 392.5 as potential support. Market's tested up against this number today a bit. Overhead resistance is at 402.5. And if the market breaks down further, then we're looking at 382 and 3/4. And then overhead potential target in the event that the market's eventually able to make its way back up sits at 412.5. A confluence of analyses shows that the $10 mark is very, very important for the May soybean contract. The market right now has actually given us 3 sequential lower highs. In the event that the market continues to break down, especially breaking down below 1013 and a quarter, we're looking for the market to come down somewhere in the neighborhood of $9.98 to $10. Upon reaching that area, this is going to be a critical zone as to whether or not this market's able to survive. The move that we would be looking for from this point would be a bounce from that $10 mark with one final advance that creates another sequential lower high. And from here, the market could then point back down again, at which point it could finally put in what looks to be a potential final low that comes in somewhere in the neighborhood of that $10 mark again, or maybe as low as $9.87, at which point this is a buy potential, although on the bounce up, we can have a potential short opportunity in this contract. Right now, again, we're looking at the supply and demand report to give us good guidance, but from what we can see right now, the sequential lower highs tell us that the market has been significantly under pressure, especially with the record crop numbers that we're seeing from Brazil. The market has done in tracing our timing angles. You can see our 1x1 down angle is where the market has repeatedly found potential support as it hit here, once again here, and even today and yesterday hitting up against it here. Overhead, you can see our angles also providing very good resistance overhead. And the recent movement that we saw most recently was the touch of this angle here where the market then dropped from here. What we're looking at now is potential support coming in somewhere near the current angle that we're at. But if that support once again does not hold, then we should see the market making a move down to the next potential timing angle, which once again coincides with that $10 mark that we spoke about just a moment ago. The July contract has a similar pattern with subsequent lower highs. As you can see, the market is hitting up against those key levels that we had in the past. We're now testing previous support, and breaking below here, the market could very well make its way down to about 10.15, at which point we could see a bounce. That 10.15 mark actually happens to coincide with volatility-based support, and so we'll look for some strength here, and additionally, previous lows came in very close to that very same level also. As the market comes in inside of these levels, then it's going to be very important for us to pay attention to the previous support and resistance levels that we've seen in the past. We talked about the importance of 1080 over the past couple weeks, and you can see very well how that 1080 is exactly where this market collapsed from. The next level just below was a 1047 quarter, and again, as mentioned just a moment ago, the next key level then we would be looking at is 1015. Unlike its counterparts, the November Beans contract, instead of making subsequent lower highs, has actually made a triple top. You can see from the movement here that the recent highs have all hit along the same area. Additionally, instead of making lower lows on the moves down, it actually has been making higher lows. In doing so, the key area that we're looking at right now is currently very close to where he's trading. As long as it's able to hold near that $10.05 to $10 area, this market actually in and of itself is poised for potential strength down the road. The pattern that we're seeing here suggests that short-term soybean is weak, but long-term it could potentially get some legs after it's able to get through the South American harvest timeline, which lands us at about maybe late to mid-April, where we can finally see a potential low coming in with some sideways movement or some choppiness over time before this market's actually able to move up into the summertime. Key support and resistance that surrounds this contract lives at 1043, 1045, 1044, 1027 and 3/4, 1012, and 996. These are going to be some very important levels for this contract going forward. Key levels also to reference for long-term usage of option selling and buying contracts. July wheat made a significant high several weeks ago up at 488 and 3/4. And that high continues to be a very important level for this contract. It made its way up just past volatility-based resistance, and since then the market dropped and came back up to retest that volatility-based resistance area. We've had 2 or 3 days of weakness now since it reached that high of about 476 and 3/4, and the market looks to make its way down. If we were to replicate the move that it did on the way from 48 to the recent low and simply copy that range, that gives us a potential ABC pattern where the market could come in and touch somewhere in the neighborhood of 441. This would make a one-to-one correspondence of the move, and anything much lower than 440 tells us that this market is particularly weak and could potentially extend even lower. So as the market comes in here, we're looking at a potential target of 441 and something in the intermediate range, perhaps at about 450 or so coming in. One of these two areas will probably be very good support for this market to bounce off of before continuing lower with pressure. The December contract has similar price action, and for this contract, we can see the key support and resistance levels lie at 519, which was very close to the recent top that we saw. Just below, we have 507 and 3/4. Interestingly enough, you can see how the market came in pretty much exactly at those levels when it made their highs. Just below at 496.5, and then we have below that 485.5. And in the event of a major break, we're looking at 474.5. So these are going to be the key levels that we'll be looking at. But what you'll also will notice is as the market makes its movements, these levels actually afford us the ability to see very important support and resistance levels that the market likes to respond to. And so as the market has come in and made these levels here, in conjunction with key price action patterns, this is where we look to be able to lean to find key spots to be able to put together key marketing strategies to help us more effectively and more efficiently navigate through the markets. We'll close out once again with the crude oil contract. We've long been warning or suggesting that this contract was due for an explosive move to the downside, and today we finally got that move. We talked about a window of opportunity previously, sometime this week and potentially early next week, where the market would look to begin a massive move to the downside. And today we've gotten that explosion as the market crossed that 53-ish number that we've shared with you in the past. As you can see, the market came in and made a nice touch of that number a couple days ago. In doing so, the pattern that we're seeing is very consistent with what we suggested. The market had a breakdown early on a couple weeks ago, a false break of sorts where it moved back up, and we suggested that as the market came back in, the next time it comes down, individuals would be more afraid of taking that position or taking that short to the downside. The market came in and touched a little bit, moved up, it shook out the weak hands, and today we find ourselves with a very big move to the downside if you took it upon yourself to take advantage of this trade opportunity. Additionally, as you can see, as the market came in, it consistently made lower highs, suggesting that selling was taking place, forcing the market itself lower and lower in its inability to maintain its level across the lower end of the trading range that we had seen. The break we see today is consistent with the movement that we've been anticipating, and hopefully you've been able to take advantage of this move. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.